See my buddy right there? The mosquitoes love him and they are eating him alive. Me? Mosquitoes don't touch me. And this recession doesn't touch my investments either because baby, I'm recession proof.
One shot, now the future is yours. Go! I'm turning dreams into reality. Yeah, it's one shot, now the future is yours. Go!
Well, today we're going to be talking about why real estate is recession proof. And my goal is always to make my own investments as recession proof as possible. Because guess what happens several times in your lifetime? We go through a recession. We are in a recession right now. And that means that your finances might be in trouble and they're about to explode unless you can recession proof them. So why is a recession such a big deal? Well, it's about this stuff. You see, in a recession, if people lose their jobs, or if we have something like inflation where the value of your dollar goes down, there's $10,000 out the door on this $100,000 every single year. I lose half of my money over the next 5 years. This is the problem. We are right now entering a recession, and if you just bury your head in the sand like an ostrich, you're gonna get eaten alive. As of August 2022, inflation is high, and the US economy has recorded 2 consecutive quarters of negative GDP growth. Though the unemployment rate remains the lowest it's been in 50 years, by most standards, we have entered the beginning of a recession, no matter how badly Biden and the administration want to spin it otherwise. Right now, it's raining cats and dogs, and people are getting hurt left and right, and it's going to get a lot worse before it gets better. You remember the Great Recession of 2008? Do you remember what happened to home prices? They plummeted everywhere because what they had done is they had grown and skyrocketed and grown and skyrocketed. And people are thinking this. After that pandemic, we saw 2 years of insane consecutive growth. Nationwide, we saw most real estate increase by 50%. So you have this house, for example, that was worth $200,000. Now it's worth $300,000. Here's what's wrong with this. Over the last 65 years, the average house appreciates 4.65%, not 25% or 50% like we've seen. Now, don't get me wrong. I own a lot of real estate. I've transacted thousands of properties. I'm making a lot of money. But is that also true if the market comes crashing down now like it did in 2008? Despite the prospects of a home price correction, a housing market crash akin to the Great Recession of 2008 is highly unlikely. Fitch Ratings says the main reasons are because housing inventory is still constrained and existing homeowners who have benefited from low mortgage rates are unlikely to sell their properties. In other words, in this country, before the recession started, we were missing 5 million homes. And that shortage started back in 2008, and we've never fully climbed out of it. In fact, right now, we have a lot of people that are forced to rent that we're going to be buying, and what slowed that buying, exactly what the government is trying to do right now, is they're trying to put a halt on inflation. It's their number one financial crisis that they're dealing with. How are they managing that? They're increasing rates. Each quarter this year, the Fed has increased the rates as promised. And what's happening is a lot of people are saying, wait. I was going to buy that house for $500,000, but now that you've increased the rates, my mortgage payment just went up $1,000 higher. I can no longer afford to buy that. What are they doing? They're starting to exit the market. It's slowing things down. And frankly, this is something that the government needs to do because this country shouldn't have real estate appreciating at 50% year over year. That itself is unsustainable. The big question, what's going to happen next year if the Fed decides to start lowering rates again? Well, they're going to have a handle on the economy. They're going to start re-stimulating it. And frankly, they need to because we have that inventory shortage. Check this out. As of 2019, 36% of the nation's 122.8 million households were renters. This means that over 44 million households in the United States are renting, and the number is trending upwards as more and more people are being priced out of homeownership. Now, this trend isn't something that can last forever, which is why they're slowing things down by bumping up the rates. They're getting a handle on the economy. They're learning how to control things because this bad boy needs to return to some concept of normalcy. In a recession, what ends up happening is really expensive homes that are priced well over the median, they start coming down in price and all of a sudden they become more affordable again. And if the Fed will then lower the rates, people can start buying that again. So imagine this relationship where if real estate becomes too expensive, people can't buy it. But if they increase the rates, then all of a sudden the price has to start coming down again until people can buy it again. And all they have to do is lower the rates, and all of a sudden people can start pouncing on that price again and they can take advantage of it. But does that mean that real estate's gonna crash? Does it mean that all real estate is gonna go down in value? This is leading to a new norm. Something is changing fundamentally, especially in our version of the American dream, where it used to be that house, the white picket fence. Check this out. A growing number of Americans make relatively high salaries, but are choosing not to buy. I wonder why. In 2019, a Wall Street Journal analysis of Census Bureau data reported that the number of households with six-figure incomes who were renting had now reached 19%, which is up from 12% in 2006. In other words, we're seeing this migration, a shift where people are saying, I'd rather just rent rather than own. Part of that has to do with the desires of the millennial generation, because for them, freedom, flexibility, mobility, these are some of the most important core values to them. They're not exactly wanting what the previous generation of boomers had. So it really begs the question, is real estate really recession-proof, or am I full of it? Check this out. Not only does real estate perform well during recessions, but it also acts as a hedge against inflation. Because mortgage payments are typically locked in for 30 years, your cash flow will increase as inflation drives rents up. Inflation will also cause your home to appreciate faster. Now, I've got a big secret for you on why my portfolio does so well, but first I want you to understand exactly what I just read there. You see, if I buy a house for $250,000, let's just say it's this bad boy right here. If it is a investment property, then I'm gonna have to put roughly 20% down. That's gonna be approximately $50,000. Now, money doesn't grow on trees. Kinda does, right? I mean, it's paper.
Money does grow on trees.
But that's besides the point. $50,000 takes some time to save up and come by. It might come out of a 401k, an IRA, and I plot this down. Maybe it's equity from a primary residence that I live in, and I finally buy this property. Well, let's just say that inflation is driving real estate to appreciate at 10%. Well, is it my $50,000 that's increasing 10%, or is it the entire value of the house? This is where you have incredible leverage control in the game of real estate. It's the entire house that is going up 10%. So what is 10% on $250,000? That's 25 grand. How much did I put down? $50,000. How do I calculate my ROI? Well, if I'm 50 grand in and I've already got 25 grand back out, that's already half of my money coming back, right? 25,000 to 50,000. That's what you call a 50% ROI. Well, that's hard for the stock market or an IRA or a 401k or the S&P to try to compete with, but it's because I get leverage in the game of real estate. Inflation does not just drive up the price of real estate, however, it also drives up rents. And what that means is I get that positive cash flow in the meantime. And with that being said, rates are still right now incredibly cheap, at least for investors, because for most of my investment career, I've been paying 5, 6, 7, 8%, and I've been able to make a grundle of money. So I don't need my interest rates to be at 2, 3, and 4%, what we've enjoyed for an extended period of time, because the government's been trying to get a handle on this economic disaster since the Great Recession. So right now the big question is, how do you protect yourself? I've got a little secret. In fact, I wrote about it in this book right here, The Straight Path to Real Estate Wealth. And as I've analyzed all real estate strategies, and I like to do a short-term buy and hold, I get on my real estate with this strategy, I average a 35% annual ROI. Now that means that with compound interest, I'm doubling my money every 2 years. Different than a 401k where I double my money every 14 years. I can only double it 3 times in a working life. Here I can double it 20 times. So it makes a world of a difference as it compounds and grows. My secret, I buy my homes below the median. Think of the median, there's a more technical mathematical term, but basically the average for the area, right? It's like, well, on a bell curve, there's a few people that buy $1 million homes, but there's a ton of people that are buying these $100,000 or $200,000 or $300,000 homes. In that range down there on the other side of the bell curve, There's an average sweet spot. Right now, that national median 2 years ago before the pandemic was sitting right around $260,000. Right now, that went all the way up to over $400,000. Not a sustainable price. So by the Fed basically increasing rates, they're basically telling everyone, hey, only buy homes if you really can afford it, because with these rates, you got to be buying with a certain amount of confidence. They're going to get some control. They'll be able to lower those rates. Real estate, though, the prices, you might see the $1 million home come down in value, but are you going to see a home below the median coming down in value? Not very likely. While recession bears a risk of real estate losing value, homes purchased below the median retain their value better than homes above the median. By purchasing average single-family housing, you can protect yourself against unlikely downturns in the market. So here's the real question. Am I buying more real estate right now or less real estate right now? Well, here's what I can tell you. Right now, I am doubling down on real estate. I am buying more homes. I am not buying fewer homes. We're missing millions of them. This is going to keep driving the prices up. The government may have successfully halted some of the frenzy out there that we needed to cool off, but just think what will happen the moment Feds lower rates just a little bit. People are going to come back slamming hard and buying. Now, as a real estate investor, remember this dynamic. When real estate prices go down, population does not. We've got leverage control. What you simply have is more people renting instead of owning. But if you're the investor, that means that there's money for you to make simply in the holding of real estate. Over the next decade, to climb out of this pit, for the millions of homes that still need to be built, that's going to lead to record high appreciation. And anyone that's joining in on that trend, they're financially going to win. Just ask the average person at the point of retirement, what has more money, their retirement accounts or equity in their home? And you know what you'll find out? Even though they put all this money away into 401ks and IRAs trying to build for a bright future, the equity in their home often is actually a greater contributor to their retirement than anything else, which is why real estate is something I'm buying a lot of right now. And I just hoping to have a few extra slots for people that want to get in and buy some real estate with me. So I've bought nearly 7,000 homes over the last 18 years as a professional investor. I'm nearing $2 billion worth of total real estate transacted. I've done that before 2008, after 2008. I'm doing it right now, even deeper during this recession. And here's why. I made a decision during the last recession where I helped my investors clear over $100 million of profits in the first 5 years, that the next time we had a recession, I was not going to miss out on it. And if you don't want to miss out on it either, I have a simple partnering program, and you can learn about it in the link below. If you go down, click that link, here's what you're going to learn. If you have $50,000 or more sitting in a 401k or an IRA or equity in your home, and you partner with me, I can show you, as opposed to a 401k tripling that money over 20 years, how to 27x that money over that same period of time or more. Based on my track record of a 35% annual ROI, that takes $50,000 and turns it into over $17 million. What that means is, you can be committed to your career, you can go on living your life, but if you have real estate doing that in the background, then when retirement rolls around, you're gonna be safe, you're gonna be secure. And you can certainly speed things up and go a whole lot faster. Right now, is this real estate recession proof? Well, nothing's really guaranteed, but based on the market's history and my personal track record in history, I'm going to tell you right now, I'm going all in. So today I told you that you should buy below the median, but that's actually one of 5 things that you need to do when identifying the right kind of property that can lead to at least a 25% or greater annual ROI. That minimum double digit 27x's your money over 20 years compared to the stock market. If you want to learn exactly what my criteria are, what those 5 things are, watch this video right here and let me show you.
Maybe stand a little bit closer to the tree.
Yep.
Try to frame that up. Yeah.
Okay, ready? Okay. Ready?
See my buddy right there?